Hello, and welcome back to the Black Tie Lounge. Very happy to have everyone back tonight, from wherever you are that you're tuning in. And thank you, Colin, for joining us tonight. Colin is the CEO of Omnique Fund, and we're going to have a bit of a chat and deep dive into Omnique tonight. So thanks, Colin, for joining us.
Yeah, thanks for having me, Caroline. Pleasure to see you.
Wonderful. As always, just wanted to walk through a couple of the things in regards to our webinar. We have a love list of questions for Colin that we're going to have a bit of a chat about tonight, and we welcome all of our guests to ask Colin some questions at the end of the session. So keep your questions handy, and we will give you a reminder to start working through them in our Q&A session. And if we don't get to all your questions, we will make sure that we are able to make contact with you and answer anything we may have missed. So thanks again for joining us. Colin, can you just maybe kick off tonight's session and tell us a little bit about yourself and how you have got to the stage now where you're at in the Omnique Fund journey?
Yeah, no problems. So I've been doing property developments since 2014. And from there, I've experienced the challenges and the needs for lenders and property developers. And then as time progressed, I then saw a market for the finance market, a market for lending in Australia, because particularly in private lending. The interesting statistic about Australia is for every $10 that's needed, there's only $1 available.
Yeah,
Private lending market. Yeah, whereas if you go to places like Hong Kong or the Middle East, it's the other way around. For every $1 that's needed, there's about $112 available for them. So my idea was to help us, first of all, to help solve the market problem that we have in Australia for lending, and somehow bring the money from overseas into Australia, into niche opportunities. And I started off by setting up a traditional fund, but then we decided, as we were doing that, we actually discovered the whole tokenization process. And yeah, we decided to roll over into a tokenized fund rather than traditional because of the flexibility, the opportunity, and the unique need for it right now.
Yeah, it's been an interesting position of what you talk about there with the Australian funding landscape. And I think that the key thing is there, and we've discussed that before, is that there's not a lot of change on that horizon. So we are a country that is very short of capital, and being attractive to overseas investment in a controlled way is definitely something we should all be striving for. Omnique is a diversified fund, and tonight I was hoping you could really take us through what that means, why you chose to diversify. Omnique's got the property, the gold, the secured lending. What was your original thinking behind putting in this diversified strategy?
So through a bit of research, I found that there was we needed a fund that both catered to property developers as well as investors. Normally it's one or the other. And we needed a fund that was secure, more secure for investors, but also a little more liberal with property developers, with what's needed, especially with the current property shortage in Australia. And the economic complexities that we're facing at the moment are making property development a bit challenging. But the idea of Omnique was to invest into various categories. So we're investing into gold, there's secured debt, property itself, and then property developments as well. And through those four niches, growth of gold currently and security of debt that can bring in the immediate returns token, and then the property area can bring in long-term returns. But also the gold sector and the debt sector of the token can act as a safety guard for the token. So if there is issues if a mysterious collapse within the property industry, or if there's a sudden drop in value, investors' money is still protected by the value of the gold and the owning of the debts.
Yeah, it's a great mixed strategy, isn't it, for this current market? Because the only constant we have, right, is all the change that's going on. So the ever changing world that we deal with on a daily basis.
Yeah, and another point on that is, my team and I, we sat down to work out how can we structure this so it appeals to your traditional investors who are looking into new ways of investing. So we looked at how a traditional fund is set up, where it has its categories of shares, bonds, cash, and property. And then what we thought we'd do is, rather than having those 4 core categories, why don't we target categories that are actually growing, and also categories that are in demand right now. So that's where, particularly in Australia, the gold and the debt market are pretty strong, combined with the property and then the property developments itself.
Absolutely. So in practice, when you're managing this diversification, how do you work out the allocations to achieve those outcomes that you're looking for investors?
Yeah, that's a great question, Caroline. So the way we control it, by default, we work with the ratio of 25% goes to gold, 23% goes to debt, 25% goes to land and property, and then 25% goes to developments, and then 2% goes to venture capital for business opportunities. Now, that doesn't mean we're bound into those ratios, because there might suddenly be a drop in gold, which would be an opportunity for us to go and acquire a bulk sum of that. Or there might suddenly be a property opportunity that pops up that has a very high profit ratio. We can go and acquire that. But over the life of the fund, it'll average out at being around about a quarter per category.
Okay, excellent. And so life of fund, so your fund is perpetual, correct?
Yeah, that's right. It's ongoing.
Ongoing, excellent. Look, with the gold, can we explore that a little bit more? So I understand in the fund you've actually got the gold investment, grade, reserve, bullion, but also mine level opportunities. How are you assessing, which opportunity that fits in those ratios that you've discussed there?
Yeah, so we will be investing a lot of the gold money into the ETFs and gold itself, but there are quite a few opportunities available where we can deal directly with the gold mines. Particularly in Australia, gold mines seem to have a cash flow issue. So we've been dealing with about 4 or 5 gold mines in South Australia, Western Australia, and Queensland, where they're willing to give us a big discount on the value of gold if we pre-purchase the gold.
Yeah.
So what we're going to do is set up an ongoing system where we pre-purchase the gold from the mines before it's dug. But the moment that it's dug and comes out, we've already made money on that, which protects the investment itself. And we're talking about a discount in excess of 20%. So it's a pretty attractive movement. But because that is a higher risk, we'll have a smaller percentage of the gold budget go towards that.
Yeah.
But then the main, and then we'll invest the main majority amount into either other gold funds or owning gold itself.
Fantastic. So those are mines that you're supporting. You're not acquiring those mines correct? You're forward contracting to their gold suppliers and supporting them in the debt side.
Yeah, so stage one, we'll be doing as you've described. And then when the expected outcome arrives for us, we're already under negotiation with becoming either JV partners or acquiring 2 of the mines there.
Okay.
But when we get to that stage, we'll be hiring gold specialists and mining specialists who can do the analysis for us to make sure that the investor's money is protected in that transaction.
I understand. So it's really I guess a closed loop cycle as your fund continues to mature as well.
Yeah, that's right.
All right, awesome. Now, on the lending side, I want to tackle you a little bit on this because I think your approach is great, because one of the biggest problems in the lending space, and we've had a chat about this before, is I guess how non-commercial private lending and some lending in Australia is. So, it's great for the lenders, but it's a very, very difficult climate right now for the borrower. So one of the things in your fund, obviously, you've really tackled and lent on how to make this more commercial for the borrowers. Would you take us a little bit through how you're doing the LVR approach and what makes the Omnique's debt bucket there more commercial and appealing in its approach that you've taken?
Yeah, no problems. So an interesting fact about the lending market in Australia, particularly the private lending market, is that 3 years ago, only 13% of all the money lent in Australia was done through the private market. And 87% was done through the big 4 banks. It has grown. The demand for private lending has grown astronomically over the last few years. In 2025, that's only 2 years after the first statistic, it was sitting at 34% of the market being covered by private lending. And with the recent banking changes and them pulling out pretty much of property development, it's expected that the ratio will go up to being about 52% of the market this year. So that was another motivator for us getting this going now, is while we can become established during the growth cycle, the growth phase of the new opportunity, and that way we can hold our share of the market, but also grasp the potential company value growth over the next few years with this, and token value growth.
Yeah.
So back to your question there, the lending market is, developers are struggling at the moment because there is a shortage of money in Australia. What we'll do by default, we go by the 65% ratio on that. But because of the flexibility that we have with working with the token system, if it's a good project, we can bring the token in to become either an equity partner or offer a higher rate in venture capital to the developers. This way, it protects the developer and the development, but it also protects the investor at the same time.
Yep.
And we can also make a deal with the developers on becoming JV partners in the development as well. So we can be the funder and the provider, and they're the service and doers for us on that. And this is what we're wanting to do with our first larger developments that I list in our IM. We're acquiring the land. We're going to pay for the build, but we're getting qualified niche developers who know those particular areas and those particular government bodies in those areas to do the project for us. And for investors' confidence and investor security, we will be monitoring everything they do, but we're also maintaining the relationship with them by injecting the faith and the trust into what they do.
Yeah, it's like a controlled fund through, but with a better commercial outcome for these developers, and it gives everyone a little bit more consistency and I guess surety, considering the market has got a lot of fluctuation on it, obviously with fuel issues, supply issues. So having that all sort of managed semi-internally is really probably a risk mitigation factor these days.
Yeah, that's right. And we're also, the fact that we're also backed by our gold arm is we've got quite a large bracket of protection there if the development doesn't work out too. So
yeah, it's a good buffer. Yeah, that's good.
Yeah.
So speaking of those assets, you've got quite a few premium locations: Manly, Carlton, and Cleveland. Is it a deliberate strategy? That you're targeting any specific, high demand or high growth areas? Why have you targeted those particular assets, and what is it that makes them fit in the Omnique Fund?
The key reason for targeting those assets was in property development at the moment, there's quite a low profit margin in low to medium range developments, and also even medium range themselves. So your typical family home, there's actually a lot higher risk and less profit to be made. But with the higher end, there's actually a good percentage of profit to be made out of each development. So that was one of the key reasons for targeting these properties. But also these particular properties hold good value, and the value in these properties makes it easier to get traditional finance to do these developments. But then that would be backed by the safety of the token of Omnique with that. So there's actually, it's still quite a high demand for luxury property in Australia, but with the current economic circumstances, like the hike in interest rates and the cost of the build, it's becoming harder for the lower to medium range property developers to make a good margin.
Yeah, no, I hear on that. It's finding that niche there in the market and how you're going to deliver that niche. And I think there is a bit of a niche in those particular type of builds, especially if you can get them cost effective versus how a lot of them are blowing out at this particular time and then having difficulty in the follow through sales.
The reason we chose those properties too is they're in areas where you have very wealthy families ready to downsize.
Yeah.
So all the parents, all the kids have moved out. Parents have had their 10 years in their old house and they want to get to retirement now. So they want to sell their other property, downsize into something luxury. That was another key reason for these areas.
Yeah. And I'm seeing that obviously the target properties that you've got there that you're working through, they seem to be medium to low risk because of the sizing as well. So I'm assuming that is part of what you're looking at with risk mitigation, like there's a comfort level on what size of development that the fund will look at.
Yeah, that's right. So the idea with the fund down the track is we'll have maybe 2 or 3 large developments, and then about 20 or 30 medium-sized smaller developments on that. So then that way we've got the risks spread across. So we're not putting all the money into 1 or 2 big projects. So if something happens to one project, we can help it balance with the other projects.
Yeah. Okay. Look, I really appreciate where you're deep diving into here. I think one of the things that we had was, we've talked about your how the portfolio management is being done, and I guess over the next 24 months, where do you see the biggest opportunities? 2 questions that are here. for the fund, but also if you can maybe just talk to us a little bit about where do you think other opportunities are that are coming into the Australian market at this point in time?
Yeah, okay. So there's definitely still opportunity within the Australian property market, especially with the housing shortage. So currently there's the NDIS system, and then you've got your normal housing. NDIS alone is short 450,000 houses around Australia. And then your normal family day, you and I type of home, we're short close to 1 million of those houses around Australia. So we figured if we can at least help fulfill 1% of that market over the next 2 years or 3 years, everyone's winning. So the investors are winning, developers are winning, and our nation is winning too with being able to buy their houses. So that's one of the key points there.
Yeah, it's a lot of housing pressure that we currently have, and really there's just no ease to that. The building cycles just simply cannot keep up, and then obviously all the disruptions that cycle is having on a regular basis is not making it any easier either.
Yeah, and then with your question there in relation to gold, there's been, because of the advancements in technology and science with the minerals, at the moment, the gold industry is sitting in a unique position where they can go and reopen past gold mines that have been closed for about 20, 25 years. They now have the technology to actually keep digging and get what wasn't dug back then as well. So that was another motivator for looking into gold. Because there's going to be a lot more coming through soon.
Yeah, there's a whole rejuvenation on that industry, isn't it? As the extraction methods and the technology being used in those methods, and obviously the price of gold continuing to rise, and the demand, the global demand for gold is hard to fill the appetite at this point in time. All those pressures are really making the gold opportunity, or any precious metals opportunity for Australia, very, very important right now.
Yeah. And with relation to the same question and the debt category, in Australia, a lot of people have had, particularly developers, have had a very negative experience with the big banks. They've laid out impossible criteria. They need 70% of your property to be sold before they lend you money. But the catch-22 there is your property is going to grow by 30% over the next 2 years, and you're going to lose that. So that's where we want to come in as well. Like, private lending does offer a slightly higher rate, but it also offers, the developers are quite happy to pay that higher rate in return for the flexibility and the trust in the money.
Yeah, because it makes commercial sense for them. That they're going to have an uplift rather than being pushed to do pre-sales at a rate which is effectively a discount for them once they settle the building. So, when they wash it up, it's a much better experience for them.
Yeah.
So I've got a couple more questions for Colin, but if you can get your questions ready, and our team will work them through for Colin and I in just a moment. So please feel free to shoot your questions up. One of the things that I wanted to just ask you was, if we talked about key takeaways for investors or anyone looking at the Omnique Fund, what would be 4 key takeaways that you'd like to sort of highlight about the fund that you think really, the fund really stands for, and what this fund is setting out to achieve?
Yeah, that's a great question. So one of the key motivators for the creation of Omnique is we want to set the fund up so it looks after both the investor and what it's investing into, the parties invested into. So that's why we spread the risk across 4 different categories, which would then lower the risk for the investor. So one of the key purposes was to make it an attractive return with an attractive safeguard on it for the investor. Another point is that Our property industry, and pretty much nearly every industry as a whole, is at a point where they're all looking for an alternative way of investing and borrowing. And with what's required to have a traditional fund, it's not very attractive anymore, or a lot of what's needed in the market now can't meet the criteria of a traditional fund. So there's actually a lot of hungry businesses and hungry opportunities out there needing a new way of investing. And then the other thing is we're ready to grasp the opportunity that sits within the market, within the interest of investors, and also within the potential future outcomes of our token. And with all of that, we've tried to make sure, we've made sure that this sits as a balanced model.
Yep.
So if anything happens with the property market, it's protected by the balance of the gold. If anything happens with the gold market, the property market will, because normally one goes up and one goes down, these will be hovering with each other.
Yeah. Fantastic. We have one question about your IM. So the IM will go live on the Asset Hub tomorrow after this webinar. So we have held that back just to tease you, of course, but it will come through and be live tomorrow. So thanks for that question, and we'll get that out to you. There is also, I guess, that was it, yep, for that question. And here we're getting a question about, can you explain a little bit more detail the value of the token and its relationship to the overall asset of the gold, troy ounce, as appears in cryptocurrency, etc. So maybe just talk about a little bit that Omnique token and how it's worked on its fund valuation, Colin.
Yeah, no problems. So the token itself is valued based on the 4 categories of investment. So there's the property, the actual property developments, the gold itself, and then the revenue generated from the debt market. Now, with that there, each of those sectors will have their own valuation once it's all in full operation. And then the overall token value would be a combination of those 4 values combined. And when you look at the current circumstances of the world, gold is going up, property in Australia is still going up, the demand for debt is going up, and the value of just holding onto land in Australia is also going up. I'll give you a quick example of the value of the land. One of the properties that we're looking to invest into down the track, it sits in Brisbane. It's currently farmland, but Parliament in the next 3 months will be talking about rezoning it to residential. The value of that land will multiply by 7 when that is rezoned. And the token, once we're in full operation, we want to acquire that. We're in discussion with the owners.
Mm-hmm.
We won't have to take much risk on that land to actually help build the value of the token.
Yeah.
With that.
Yeah, and that's the great thing about RWAs, because they are backed by the actual value of the assets that they're representing, that when these opportunities are taken by fund managers and you have that type of return, then the next valuation cycle, the capital value of the actual fund token, is able to reflect that. And that's what I think is quite exciting about having a real world asset fund listed, because now people that are able to buy into your fund and have those shares will get the chance to be part of that opportunity. So, that is what we sort of set out to do. So it's great to hear that you've got these in your pipeline.
Yeah, and on another point there, one of the grassroots ideas behind Omnique as well was, at the moment, you can either find yourself a fund that brings you a cash flow, but not a very high growth over the life of the fund, or you can find yourself a fund that brings you a high asset growth but not a very good cash flow. And the idea here was to be able to combine both, a token that would grow in value over the next few years, but also give an annual return to our investors and a confident cash flow.
Yeah. Speaking
That's
of
where
that
the debt and gold came in.
Yeah, well, speaking of that return, what is the annual return for the Omnique Fund? Your base target return?
Yeah, our base target return is 10% per annum on that.
Yeah.
That's what we're promoting to everyone, and yeah, it'll be interesting to see what the real outcome is when you look at what's happening around the world right now. It'll be quite attractive.
Yeah, and let's talk about that, because there's a good chance that you will achieve higher than that benchmark. What happens if you have earned? So, say for instance, you've acquired that property in Queensland, you've made 7x on there, and you've sold some of that after development. That's quite a substantial profit that the fund will make. How does that get returned to investors on top of their base return that you're targeting now?
Yeah, so the profit, if the profit exceeds what was anticipated, we split that profit with the investors and the fund. It just depends on the level of profit as to the ratio of the split. But we definitely share the benefit with our investors on that. And we also, in those circumstances, we can make arrangements where instead of having the cash paid out, we can give them a discount on replacing it with tokens with the profit, or so on there. We're open to it, but we make sure the investors reap the benefit as well as us on that.
Yeah. So understanding you have reinvestment opportunities as well as return dividend payouts, so they can make their choice as the investor.
Yeah, that's right.
Excellent. Well, that's very exciting. I don't think we have any more questions that have popped up. So we have, I think you've done a fantastic job tonight, Colin, and thank you for joining us. Always love having a chat and hearing.
Yeah, thanks for having me, Carolyn.
Yeah, amazing stats. Yeah, I love some of the stats that you kind of have been able to come up with and find. I just find them fascinating. So thanks for your time, and I'll look forward to having you on board, I'd say in another 6 months, and we'll have a bit of a recap and see how Omnique Fund is tracking. But I'm pretty sure the results are going to be very, very nice. So congrats again to the team. We have one more question that's just popped in. Have you got time to stay and answer this one?
Yeah, no problems.
Okay, so it's talking about the 10% return. That is after all expenses. So just asking whether that target return is net or gross.
Yeah, it's after. Are they referring to their own expenses or the expenses of the fund?
Expenses of the fund. Yeah.
Oh, okay. Yeah, it's after all expenses. Yeah.
So hopefully we answered that one for you as well. And again, Colin, thanks for dropping by tonight. And we'll see you soon in the lounge.
Yeah, thanks a lot, Caroline. It's always a pleasure to talk with you, and I really appreciate all the effort you've put into this so far.
Excellent. Have a great night, and thanks everyone for attending. We look forward to seeing you on our next webinar. And if you're in Sydney, come and join us at our open mic session, so you can get to come and meet Colin in person, because I think you are there on the Tuesday the 24th at our Sydney offices. So come down, come and meet the team if we haven't met you already, and we look forward to seeing you then. Have a great night, everyone. Take care.